The tax-free savings account, TFSA, is maybe the most powerful savings tool in Canada. So in this video, I'll go through 10 of the most important things you must know about the TFSA so that you can maximize your savings and avoid some costly mistakes. The first thing we need to know is, what actually is a TFSA and how does it work? The TFSA, tax-free savings account, is a tax advantage account. Any money that you put in, the growth of it, and when you pull it out, is all 100% tax-free, which makes this account such a powerful tool. Now, one of the key things you need to understand with the tax-free savings account is that it's not really set up as a savings account, even though it has that in the name. It should be a tax-free investing account. And so what is it? It's an account where you can invest money, grow your money, and pull it out absolutely tax-free. And so again, I'll cover more of this here as we go forward in the other 9 points, but it's a really important account. And if you don't already have one open, make sure you get it open as soon as possible and start using it to your advantage. Are TFSA contributions tax deductible? No, contributions made to your tax-free savings account are made with after-tax dollars and are not tax deductible. So when you make a deposit to your RRSP, your Registered Retirement Savings Plan, you get the tax deduction. But again, you're taxed on money when you pull it out. The tax-free savings account, you do not get the tax deduction. It is after-tax money, but again, it grows tax-free and is pulled out tax-free. So the accounts work differently, but again, that's where it's a powerful tool, is that you can utilize it for planning purposes down the road when you need that tax-free income. What is the annual TFSA contribution limit? The annual limit varies and it increases with inflation over time. For 2025, your annual contribution is $7,000. Now, the TFSA was introduced back in 2009. Back in 2009, if you were 18 years or older, you would have had maximum contribution since that point, as long as you were in Canada. That total lifetime contribution limit is $102,000. So if you were living in Canada in 2009, have never made a contribution to your tax-free savings account, and were at least 18 years old back in 2009, you could contribute up to $102,000 to your tax-free savings account as of 2025. In 2026, there'll be a new contribution room limit, which we'll introduce in the future here. But for 2025, the current new contribution limit is an additional $7,000. If you're not sure what your contribution limit is, maybe you've put money in, money out of your TFSA over time, and it's a little fuzzy, log into your CRA account and it will show you what your limit is. Now, again, if you log into day one, caveat here is that it will not include, until you do your taxes for 2024, any contributions or withdrawals from 2024. How is the TFSA contribution room calculated? So as previously mentioned, the contribution room is based on any unused contribution room from previous years plus this year's room. Now, where it gets complicated is if you've withdrawn money from your TFSA. So let's use the example of 2024. You had that contribution room of $10,000 that you could put in. Some from 2024, some unused from previous years, but your total contribution limit was $10,000. Let's assume you put in $10,000, but you also later in the year pulled out $20,000. So you've maximized your TFSA in 2024, but you made a withdrawal of $20,000. Come January 1st, 2025, you were given an additional $7,000 contribution room for 2025. Plus, because you took out $20,000 in 2024, you get that back the following calendar year. So come January 1st, 2025, in this scenario, you would have $27,000 of contribution room. So contribution room in the new year here now in 2025 is made up of any unused room from previous years, any withdrawal from last year, plus new contribution room from this year. And yes, it does get a little complicated, and that's why you have to continue to track it and pay attention, because over-contributing to your TFSA can be costly. What happens if I over-contribute to my tax-free savings account? Well, the penalty is quite steep. It's 1% on any over-contribution amount on a monthly basis. So it's a very punitive penalty. So make sure you understand your limits, how much you put in. And if you're not sure, play it conservative, because over-contributing to your TFSA can be very expensive. We've seen penalties happen now early on, 2009 to about 2015. they weren't really heavy on mandating the penalty, but lately we've seen a lot of penalties come through. So make sure you're not over contributing to your tax-free savings account. Can I hold investments in my TFSA? The answer is yes. And that goes back to my comment about the TFSA should be a tax-free investing account, not a savings account. Now, some of you have a short-term need, you have lots of contribution room, and sure, you can use your tax-free savings account as a savings account, put it in a GIC or a high-interest savings, and earn your couple percent. But where the power of the tax-free savings account really takes effect is investing that money. So for many of you, myself included, my tax-free savings account has very similar investments to my RRSP account. It's for long-term growth. I want capital appreciation. I want growth in that account because that growth is tax-free. So I don't want to earn just 1 or 2% in that account because the advantage of earning that tax-free is limited then. I don't want to take too much risk because I don't want to lose all that money because I'll lose that contribution room. So it's a fine line. I want to play within my risk tolerance and asset allocation mix, but I want to invest that money. So I'm going to be invested in ETFs, in mutual funds, in stocks, in a number of investments. Essentially what you could invest your RSP in would be the same as your TFSA. Make sure it's part of your comprehensive retirement plan and financial plan, but make sure your TFSA is actually working for you and you're taking advantage of the tax-free income. Can I withdraw money from my TFSA at any time? Yes, you can, and withdrawals, again, are absolutely tax-free. And this is why as you get into retirement, having a funded TFSA account is really important because if you have an emergency or you just need more income without driving up your taxable income, a tax-free savings account can be a great tool to use for that resource. So again, you can take money out of your TFSA at any point, just understand the limits. Anything that you take out of your tax-free savings account in 2025, you'll get that contribution room back in 2026. So as an example, and this is a caution for all of you, let's say coming into 2025, you have maximized your TFSA. January 1st, you contribute an additional $7,000, new contribution room here for 2025. Moving through 2025, you need a bit of money and you pull money out, let's say $10,000 out of your tax-free savings account. You cannot put $10,000 back in until 2026. You've already maximized your TFSA. It's not a money in, money out account. So be careful with that. You can take money out any time, but if you've maximized the room, you don't get that back until the following calendar year. So if you've maximized your TFSA, let me say this again. If you take money out, don't put money back in until 2026, and you'll get that contribution room back, but not to the following calendar year. What happens to my TFSA if I move abroad? So if you move abroad or retire abroad and you have a tax-free savings account here in Canada, you can hold on to it. It's not something that you have to necessarily liquidate, but you won't be able to put new contributions into your tax-free savings account. Again, if you're moving abroad, you want to make sure you talk to a cross-border tax accountant. Moving abroad, there's a lot of tax nuances to it. Your TFSA is one of those. But in general, for most of you, as you move abroad, you can continue to hold your tax-free savings account here in Canada. It will be tax-free. You just can't make new contributions to the account while you're living abroad. Can I use my TFSA as an emergency fund? At the end of the day, yes, you can use your TFSA for whatever you want. Of course, if you use it for an emergency fund, that money should be invested in very safe, very liquid, very tangible assets, meaning that if you need the money tomorrow, you can get it without penalty. And that typically means you're investing in something that's not earning a lot of interest, which is fine for an emergency account, but it's not an ideal situation for your tax-free savings account. Ideally, you're utilizing your tax-free savings account for longer-term growth. Your emergency fund is more in a non-registered account that's earning 1 or 2%, and you're paying the tax on the growth, but it's not a lot of growth. Let your tax-free savings work. If you're in a situation where you're not maximizing your tax-free savings account anyway, you have an emergency account, yes, you might as well then use your tax-free savings account because even at 1 or 2%, you're still saving taxes on that growth amount. So again, your tax-free savings account can absolutely be used for your emergency fund. So if you have no other use for that room, use it for your emergency fund. But as things progress and as you save up more money, you may want to shuffle your emergency fund out of your TFSA and utilize that TFSA contribution room for better growth opportunity to earn more money, potentially tax-free. what happens to my TFSA when I die? If you're married or common law, you want to make sure that you've listed a successor beneficiary on your TFSA account. What this does is it allows your spouse or common law partner to take over your account even if they don't have the contribution room. Now, rules in Quebec are a little bit different. I won't cover that in this video, but anywhere else in Canada, you want to make sure you've listed a successor beneficiary. So let's say you have Joe and Sally. Now they both maximize their TFSA account, so they don't have any contribution room left. But Joe passes away and he's got $150,000 in his TFSA. It's grown over time, and Sally also has $150,000. If Joe has named Sally as his successor beneficiary, Sally can take over Joe's account and essentially have $300,000 of TFSA. So a successor beneficiary, or successor holder as it can sometimes be called, has to be a spouse or common law partner. And if you are married or common law, make sure that you've listed this. So wherever you hold your TFSA, make sure you've listed that successor holder or successor beneficiary on your account. If you're not married or common law, then you want to make sure you name a beneficiary. When you pass away, all the growth to the date that you pass away is absolutely tax-free. So if your account's growing to $150,000, that will be passed to the beneficiaries, whether directly or through your estate, on a tax-free basis. If your TFSA continues to grow after date of death, the growth after the date you've passed away would be taxable. So again, going back to if you are married or common law, make sure you've listed a successor holder or a successor beneficiary on your account. If you're not married or common law, you can name a beneficiary to make sure that that money is passed on to the person you want to be passed on to, and any growth to date of death is absolutely tax-free. So as you start working on your financial or retirement planning heading into 2025, make sure you understand the tax-free savings account. Again, a very powerful tool. I've covered off a lot of how it works and the nuances here in this video, but if you need to learn more, we've done a lot of videos on our channel around the TFSA, so check those out. And if you need help with your retirement planning, reach out to our office. We offer fee-for-service retirement planning. You can learn more at parallelwealth.com/planning.